All right. Happy New Year from Money Club Mondays, January 3rd, 2022. Ready to kick off a awesome new year with a lot of big plans and a lot of things happening and going on. So first and foremost, I hope everyone had a good start to the new year and has their goals in place. And hopefully you're already off to the races meeting those goals. So for me, I'm focusing on health and wealth this year. So definitely going hard with some fitness goals and also with continuing to build everything that we do here at the Money Multiplier and the Private Money Club, as well as getting my own personal businesses and finances continuing to rock and roll as well. So I hope everybody is prepared and ready to go. So welcome. So today what we're going to do is we are going to get into building wealth using your infinite banking policy, using your private whole life insurance money multiplier policy, and generating extra streams of income and what that means to you. So that's what we're going to talk about today. I was supposed to have on a special guest, one of our borrowers in the Private Money Club, Dwight Harrison, who was on a few weeks ago, but he fell ill over the holidays, not feeling good, has a bad sore throat and stuff like that. And he said he's doing okay, just doesn't have any voice to be able to talk. So we'll have to reschedule him for 2 weeks from now. Next week, Kevin Shortell is going to be joining me next Monday to talk about notes and investing in notes. So if you're looking to have that'd be a great strategy for what I'm going to teach today about leveraging your policy and using it to create extra streams of income. So next week I'll have Kevin Shortell on, and the following week we'll bring Dwight back on. But this is a perfect start off for today that he couldn't show up because I get to get into a topic I've been wanting to talk about, which is creating passive income streams and how you can do so using your infinite banking policy. So let's dig into this. As we get going, like always, just put your questions and answer in the Q&A box or put in the comment box and we'll get to them as we roll. So those of you that are looking to generate additional streams of income this year, this will be a really good training for you right now. Whether you're on the lender side, whether you're on the borrower side, all of it's very important because you need to know how both sides work to be able to generate these extra income streams. So let's get into it. So when we talk about passive income streams, what does that mean for you? So what it means for me, and one way that I always used to look at this, and what an income stream is money that's coming into you. So it's basically a paycheck or direct deposits or some kind of money that's coming into you. Now, most people have a single income stream, right? Their job. You go to work, you work a certain amount of hours, and they pay you hourly, or they pay you a salary, or they pay you commission, or they pay you bonuses. But that one income comes from that one source. Okay. Now, a lot of people will go out and they'll get a second job to create an extra income stream, maybe wait tables in the evenings, or when you're younger, do bartending on the weekends, something like that. Or they'll go out and become maybe a realtor and try and do real estate part-time on the side, or maybe they'll get into the network marketing industry or MLM businesses, things like that, to create what people call a side hustle, which I'm all for, by the way. If anybody is in any kind of home-based business, network marketing, MLM, I'm a huge fan of that. I don't do any actively these days, but I've been involved in the past, and I'm a huge fan in using home-based network marketing businesses to teach you basic business skills. Because one of the huge advantages to home-based businesses and to network marketing is you're basically doing everything yourself in running a business. So you're generating all the marketing, you're doing all the lead generation, you're doing all the sales calls, you're doing all the business side of things as far as managing, expenses and income and everything like that. So I'm a big fan. There's some really good trainers out there that teach basic sales skills and management skills and business skills and entrepreneur skills, but it kind of leads you down that entrepreneur rabbit hole, which I think is an excellent thing, and you can't go wrong. So if anybody's looking for some additional, getting into additional active business this year, two places I would say look at getting started in real estate investing, look at maybe learning crypto investing, and look at look at maybe starting a home-based business, some kind of network marketing business. And happy to talk more about that if there's any interest in the future. Maybe we can do a training on some basic things to get started in an industry like that. But today's training, again, is going to be more geared towards passive income. I just want to kind of explain, what different types of income streams are. So I want you to determine, what the different types of income streams are. So you got to ask yourself, well, how do I determine, how many income streams do I need, or how much money do I need coming in? And basically that's, long-term goal planning, and then working backwards from there to figure out how much money you need coming in on a regular basis. Because if you want to live a $500,000 a year lifestyle, but you only make $100,000 a year at your job, obviously that's not going to happen. So how do you generate another $400,000 in income to be able to, annually to live that lifestyle that you want to live? And if you don't have enough hours in the day to create additional income streams with active jobs, meaning a second job, bartending, home business, whatever it is, then what we have to do is we have to look at making our money work for us to generate additional income streams, because we're out of time. So once we're out of time to generate income ourselves, we need our money working for us, generating additional income that way. Does that make sense to everybody? So those are the biggest differences in active versus passive investing or income streams. Is active income streams, it takes your time to generate that money. Passive income streams, your money is generating more money for you without you putting in any more time. So those are the biggest differences. So how can you generate as much income as possible with your active time? And then how can you take that money and create enough additional income through passive investing to be able to live the lifestyle that you want to live? And then what is that like I said, what does that long-term look like for you? And if you want to break it down, one thing that I always did that made it really helpful, especially when I was buying rental properties, is I would say, okay, my additional income streams are every rental home that I own. So I know if I own this rental home, after mortgage, after expenses, after all the costs and everything that are involved with owning that home, how much rent do I have coming in on a regular basis? So let's say that this home generates $300 in income a month for me. This other home I have right here generates, let's say, another $500 in income a month. Okay, now I have $800 a month coming in from those two rental homes. I know that that's going to make my car payment. So I would consider those two rental houses my car homes, because the income generated from those made my $800 a month car payment. And then I said, okay, well, I want to buy a new boat. I need $2,000 a month in expense money to be able to operate and run a boat on a monthly basis. So then I would go out and I'd say, okay, well, let me look at what kind of real estate I can purchase, or how many rentals I need to purchase to be able to generate enough income for that to now be my boat home or my boat property. So I went out, as an example, this was years and years and years ago, but picked up a triplex, and that thing then provided enough income that was my boatplex, right? So that's how I would look at it. So what is it that you want? And then just reverse engineer that, and we can generate enough income to be able to provide us that lifestyle that we want. So that's a great way to look at it. Different types of income streams, passive versus active, and how to start setting those goals. And then if you know that, hey, I want to travel, on a 2-week vacation every quarter or something like that, then you just engineer that. How much is that going to cost me? How much time do I need to put away for my active streams that I can take off to be able to still do that? And then that starts allowing you to scale back. And then eventually, once you have enough passive streams where you don't need the active streams anymore to provide the lifestyle that you want, then that's when you start eliminating those active streams. And that's when you start talking about quote unquote retirement. Okay. And retirement means something different to everybody, but that's ultimately the long-term goal for almost everybody. What does your retirement look like? And most people say, I don't ever want to retire and do nothing. If you retire and do nothing, you die. But when is it that you're required to do something versus when you optionally want to go out and do something is when retirement really starts to make sense and be a real thing for most people. So that's a great way to look at that. Now, to get to these different levels of retirement or lifestyle and generate these additional income streams, we need to look at how is this possible, okay? And one thing that I'm going to talk a little bit about right now is good debt versus bad debt. All right. So when we talk about debt, there's a lot of different debates and opinions on what is good debt, what is bad debt, should you have any debt whatsoever, And what's the best way to look at that? So in my opinion, I'm a huge fan of good debt. Okay. I fall into more of like the Robert Kiyosaki way of thinking about this, as opposed to like the Dave Ramsey way of thinking about this. But let me explain. So first off, what are the differences between good debt and bad debt? What are the differences between good debt and bad debt? And I have this board here. Let me just start using it a little bit. So good, bad debt. So what's some bad debt? What would you guys say some bad debt? So what do you say? Credit cards would be good debt or bad debt? Put in the comments. Good or bad for credit cards? Okay, Mary said student loan is bad. Okay, so bad credit cards. All right, James, I like what you said right there the best. So James wrote mostly bad. So we're talking about credit cards here. Now, generally speaking, credit cards are bad debt, right? However, there's ways to use credit cards to your advantage. Now, you have to be very, very disciplined, and you have to make sure that you're able to stick to the strategy, or else leveraging and using credit cards for good debt can turn into bad debt and ruin everything very, very quickly. So it's probably a very risky way of using debt, is using credit cards, but absolutely there's ways to leverage credit cards into good debt. And in my opinion, if you are able to get credit cards with 0 interest for maybe 1 year, why not, right? If a credit card is going to give me $60,000, access to $60,000, for example, at 0% interest for 1 year with no upfront costs, why would I not take advantage of that? And then we can start talking about, how do you start rolling that into the next card, into the next card, into the next card. But if I can get a 0 interest credit card and I can take that money and I can lend it out at 12%, why would I not do that, right? So that's one way to create and use credit cards for good debt. But generally speaking, credit cards are going to be bad debt. Carrying a balance on credit cards that has interest is bad debt. Absolutely. So just wanted to throw that out there. David said boats are bad debt. I agree with that. Boats, cars, consumer credit cards are some of the worst. So things like Macy's cards or Nordstrom, or, all those stores you go into, like when I was buying Christmas presents a few weeks ago, almost every store I went in, hey, if you open up a card with us today, we'll give you 25% off this entire purchase right now, things like that, right? There's a reason they give you those discounts, because they know once you get you in, it's tough to get you out. So those are all bad debt. Absolutely. Can you put in, so Aaron said, hey, can you put me as an authorized user on that $60,000 card? Yeah. I mean, we used to work with a company, and we haven't talked with them lately, but they came on our 3 days for a while, called Seed Capital. And actually they just changed their name. I can't even think of the new name of the company. I can find out though, but they do a really good job. They have a service where they will take your situation and they'll look at they have a relationship with thousands of different credit cards and bank companies and lending companies. And they'll actually take your credit situation and your personal situation, and they can get you approved to like 100, 150. I've seen them get people approved for $200,000 in 0% cards. And there is a strategy to be used there. So you just got to be careful with it. But if anybody's interested in exploring that option, having somebody help you open up and create these 0% cards like that, I can make an introduction for you. Just shoot me an email and let me know, and I can set you over to them. And I've known a lot of people in the past that they've actually done good work with and have helped. Another good way to use like 0% cards or something like that would be for education, right? If you can take $50,000 and hire a coach that's going to help you generate $200,000 this year, is your $50,000 that you spent for that coach, is that a good investment? If they help you generate $200,000, absolutely, right? So it just depends what you're spending the money on, but that's a big part. All right, so I don't want to spend too much time on good debt versus bad debt, but you guys seem to know what you're picking on. So just to show you some good examples of good debt. So basically an example of good debt, in my opinion, is anything that generates income. So anything that generates income. So you can go take a loan from a bank. And if you use that money to buy a rental property that gives you $500 a month income stream after all expenses and everything, good debt or bad debt. It's good debt in my opinion, right? So this leads me into the next topic or the next buzzword, I guess, so to say. When it comes to good debt versus bad debt, really what we're doing, what this whole debt thing is used for is ultimately creating what's called leverage. And leverage is a very, very important word when it comes to growing and building wealth, because without leverage, we're basically stuck with only the active money that we're generating to put to use. All right. And let me explain what I mean. So it takes us a lot longer to be able to reach those goals and that lifestyle or retirement that we were speaking about earlier. Leveraging allows you to be able to do so in a much quicker and more efficient manner. So what is leverage? Leverage is pretty much creating debt, right? Because what we're doing, leverage is basically just a bank loan, for instance, right? If I want to buy a $200,000 home, okay, I can go to the bank and they will give me a loan to purchase that home, right? But to do so, I'm going to have to give the bank a down payment on my money and also a promise on my reputation, which is what credit scores essentially are, that I'm going to pay that money back. So the bank, let's just say, in most investment loans, they're going to require 20%. So the bank says, you give us $40,000 cash along with a promise using your reputation that you're going to pay us back, and we will give you $160,000 to purchase that home. So we are leveraging our $40,000 to purchase a $200,000 home. This $200,000 home, let's say, generates $500 a month. Okay. So we're leveraging our $40,000 a month into a much larger asset that's providing us a nice income stream. Does that make sense to everybody? That's all leveraging is. It's using something of value to obtain something of more value. Okay. And again, the reason why leverage is so important is to obtain that $200,000 home. I don't have to save up the whole $200,000 to go out and buy that home and create $500 a month. I can use $40,000 to purchase that same home to generate that same $500. So it just allows us to accelerate our wealth and income streams that we're creating that much faster. All right. So Sandra said individual store credit cards always have the highest interest rates. Yeah, absolutely. Because they don't have any collateral, they have nothing of value. Anytime that something has no collateral, no value, no, whatever, and they give those cards to almost anybody. So it's always going to have a higher interest rate, just like in the private money club. If you're in a second lien position, you could probably expect 15% or better returns, maybe some points involved. If you're in first lien position, 8 to 12% is very, very common. You get that extra interest because that second lien position is a little more risky than a first lien position when it comes to lending money. And there's lots of examples we can use of that. All right. So leveraging is very, very important. And one of the reasons why I'm such a huge fan of real estate investing as a means for generating income and wealth is because of that leverage aspect. Leveraging in real estate is very, very common. Now, you can leverage in the stock market. That's what margin accounts are for. That's what options are, things like that. It's just different worlds, right? So you can absolutely leverage in many different industries and ways to invest in businesses. You can go get a business loan and you can jack up your inventory through leveraging, all that stuff. But I've always been a huge fan of real estate investing. Just because it's always made sense to me. Like, I love the idea. I can see a home. I can control every aspect of it, from the purchase price to the rehab to what it's rented out at or what I can sell it for. And every single step from start to finish In every aspect of that deal, I can control everything that happens. And the stuff that I can't control, I can protect myself against. So like a natural disaster, if a hurricane hits in the middle of a rehab, I have insurance on that property that's going to protect, or if a fire happens or something like that, right? So I can control every aspect of it or protect whatever aspects that I don't. Real estate also, they're not making more of it, right? I mean, land is it's, you know, once it's sold out, it's gone. Like they're not building more land. You know, there's so many examples, you know, more millionaires and billionaires have been created through real estate investing than any other investment or any other business opportunity in the entire world. Real estate's generated more millionaires and billionaires. Real estate allows you to passively invest your money through private money lending, whether it's in single family homes to huge commercial ski resorts to everything in between. Right. So there's just so many opportunities. And the other reason why I absolutely love real estate investing specifically is because you can make money investing in real estate no matter what is going on in the outside world. So when we're in up markets, there's strategies. When the market's crashing, there's strategies. When it's a flat market, there's strategies. But as long as we understand the strategies, we're implementing them, we can make money in any kind of market, no matter what's going on. And more importantly, we can set ourselves up to make a ton of money when market conditions change. So right now, you'll hear Chris talk about how he sold a ton of his real estate rentals over the last year and a half now. Why? Because he bought them from 2010 up until a few years ago when the market was very, very low. Over the last 2, 3, 5 years, the market has skyrocketed. So he's selling up here right now. During this time, he made nice monthly passive income coming in through the rents. And now he's selling and cashing out, taking that wealth, doing other stuff with it. But I guarantee you, I promise you, if the real estate market comes down, Chris will be back out there buying more homes. So it's just taking advantage of markets, you know, as they go up and down. And that's what it's all about. But that's not important right now. What's important right now is using real estate to generate wealth, right? So lots of reasons why I love it. Hopefully you guys understand that. I'm more than happy to talk more about it, but I want to get into this. All right. So when it comes to real estate investing, you know, if you're sold on that idea and you like the idea of being in real estate right now, and not to harp on it, but the stock market is crazy highs right now. It's a different market though than, for example, what we saw in like 2008 when we saw the last real estate collapse. And I'm not going to get into that right now, but I think that real estate's going to continue to go up for a while now. At some point, we will see a correction or a pullback, but we're going to have plenty of time in between to be able to make adjustments for our loans and for what we're investing in. So to me, I wouldn't worry about that right now. I'm 100% all in on real estate investments right now. That's me personally. You guys make your own decisions, but I'm just letting you know what I'm thinking. So if you're in on real estate, then this is going to make a lot. This is what you now need to look at. Okay. So where do you want to take advantage of real estate? And then we'll get into how you're going to do that using your policy. All right. So you have to ask yourself at this point right now, are you an active investor or a passive investor? Okay. Okay. Or maybe you're somewhere in between. Okay. But you got to ask yourself, where are you right now? Are you an active investor or passive? So let me explain for anybody that's new on right now. What I mean, the difference between an active investor and a passive investor, just like I was talking about earlier with your job. Okay. An active investor is going to be somebody that goes out there and is actively looking for properties. They're actively looking to purchase either a single family home that they're going to flip, a property that they're going to rent out, a mobile home park that they're going to fix up and rehab and bring new units in to create, you know, income that way, a mobile home park that maybe they can do some value adds on, whatever the case is. But they're actively out there looking for properties that you're going to wholesale, that you're going to flip, that you're going to create long-term income through long-term rentals or through Airbnb strategy or through the BRRRR strategy or whatever the case is. But you're actively spending your time to go out there and generate income one way or another through real estate investing. Passive investors are somebody that's looking to be involved in these deals, but they don't want to be the ones using their time to get the deals done. All they want to do, okay, so these people are looking for houses. These people typically just want to take their money. Passive investors want to take their money and they want to dump it into these deals, dump the money into these deals and generate more money that way. Okay. And then people in between, maybe they have some extra time and they're actively looking for, maybe turnkey rentals. Maybe they want some, maybe they actively want to buy homes themselves and they want to get them, but maybe they want to not do all the work. Maybe they want a property manager in place, or they want a team that's going to help them go find that deal in the first place. But they do want to actively own it. They want to actively be involved, collecting the rent and everything like that. A passive investor is just going to say, okay, this person has a deal. Let me take a look at that deal. Let me spend an hour or two evaluating it. Let me spend 5 minutes signing it. And then I'm going to give the money to this person and they're going to go do their thing. I'm not going to think about it again. I'm going to sit back and each month I'm going to collect my interest. And at the end of the deal, I'm going to get all my money back. And in between, they're not going to do anything else. So a couple hours maybe to evaluate it, if that, about 5 minutes to make the signatures and then sit back and collect the money. Okay. Financially speaking, you have to ask yourself, where are you? Okay. I would say to be a passive investor, minimum $15,000. Okay. If you have $15,000 sitting around, and you don't know where to put it. There's deals, for example, in the private money club where you can invest in active deals and get this money working for you and making more money for you. Max, in the private money club, I would say probably could help you run maybe 2 to 4 million through this year. Right now, as we're growing, we'd probably get that up. But if you have more, then we should maybe have a little bit longer conversation. So you have to, and if you have less than minimum, if you don't have that to work with right now, or that, hey, putting my $15,000 to work is good right now, but I know I actively need to generate more income so I have more money I can put to work later on, then active investing is probably where you want to be. Okay. And then you have to ask yourself, do you have the time? Or can you make the time? Or where can you create the time by doing other things that are less productive, so you put more money in the active side? But over here on a wholesale deal, you're looking at 5 to 10,000, 5 to 10,000 per wholesale deal. On a flip, you're typically looking at 20 to 50K in a normal single family flip. Or if you're looking for holds, short term, long term, maybe 1 to 2K a month. Long terms, 500 to 1,000 a month. So those are pretty common numbers. If you're actively investing, you're doing short-term Airbnb rentals, it's a little more work, a little more management. Most people I've been talking to around 1 to 2,000 a month in incomes coming in. Long-term, just your typical rental properties, 500 to 1,000 a month in profit is a good way to look at it. Maybe 300 a month, depending if you're highly leveraged on the deal. What you bought it for, what the mortgage or what the money's costing you, things like that. But those are kind of numbers. So then you could sit back and say, okay, do I need to create an extra 5 to 10,000 per wholesale deal? Do I need to do flipping? Do I want to just do, properties? Because remember, if you're over here and you're doing shorter long-term holds, not only do you have the monthly income coming in, but what else do you have going on? You have appreciation. You have appreciation because if you bought that property right, over time, what's that property going to do in value? It's going to increase in value. So if that property is increasing in value, it's called appreciation. That just means an asset that you own is appreciating in value, which means your net worth, which means your wealth is appreciating and growing in value. And that's what it's all about, because there's something that I've learned when it comes to growing wealth. And there's really 2 things that we need to be able to do that. And as I clear this out, ask yourselves, think about this right now. It's January 3rd. What are you going to be this year, an active or a passive investor? And let me say this too. If you don't know, if you want to be an active or passive investor, or maybe you're exploring both options, what's best for me? Make sure you join us January 22nd, 23rd, and 24th in 3 weeks, less than 3 weeks. Our Money School Essentials 3-day virtual training event is back for 2020-22. And we're going to go into 3 days, getting into deep conversations about both active and passive investing. And we're going to go deep into how you can implement these strategies. And we're going to introduce you to experts that you can work with going into 2022. So if you want to go on the active side, we'll introduce you to some active coaches and mentors and different programs to start teaching you the active side if you're looking for that. If you want the passive side, we're going to get into how banks work, how to leverage the money, how to start setting yourself up, how to use all kinds of sources, not just your IBC policy, but qualified retirement funds and everything between HELOCs and 401ks to be able to generate passive income through these strategies. So we're going to go in depth during that training on January 22nd, 23rd, and 24th. So make sure you are attending that. And I believe it's $297, but we're still running the special $100 off for $197 to attend that training. So make sure you check that out. All right. So as you're thinking about, are you a passive or active investor? Why this is so important is because one thing I've learned when it comes to generating and creating success, when I'm talking wealth, okay, there's lots of ways to be successful. Don't get me wrong. But when it comes to successfully becoming wealthy, there's 2 things that are very important. All right. So number 1, compounding interest. Number 2, money moving. Okay. So you really need every successful person, I don't care who you are, if you're going to be financially successful and live the lifestyle and retirement you want, you have to take advantage of these 2 concepts right here. Now, you've heard us talk about this on presentations and trainings in the past. What businesses in this country take advantage of compounding interest? What businesses? What business takes advantage of compounding interest in this country? So people always say banks, and that's what I see in coming in through here on the thing. That's actually not true. Banks actually do not use compounding interest. Banks actually, and actually there's no company in this country that takes advantage of compounding interest. Okay. But compounding interest is very important. Let me explain but the reason, and you guys are all saying banks, and what banks do is banks take advantage of what's called fractional reserve banking, which means if you give a bank $1, they can lend that same dollar out like 20 different times. It's for every dollar that they have, they can fractionally take that dollar and break it up into a million little pieces and lend it out 100 different times. So that's what banks are able to do. We aren't able to do that. Banks are, because of the Fed and the way fractional reserve banking works in this country, but they don't take advantage of compounding interest. But what banks understand is compounding interest is very important. And that's why banks are the #1 purchaser of whole life insurance in this country. Because whole life insurance policies, what we do with Money Multiplier and these specially designed and engineered banking policies using whole life as the vehicle, these do take advantage of compounding interest. And actually, these policies take advantage of uninterrupted. Uninterrupted compounding interest, which is even that much more powerful, because every dollar you put into your new banking Money Multiplier policy, every dollar from day 1 that goes into that thing, it starts compounding uninterrupted for the rest of your life. It'll never stop until you die. So, but that is one thing that I've learned. No matter who you are or what you do, compounding interest is very important. Einstein said it best. Compounding interest is the 8th wonder of the world. Those who understand it, use it. Those who don't, pay it. All right. And since we can't, as individuals, do fractional reserve banking like the banks do, Stop giving the banks all your money because they're getting rich off of it, not you. You give them $1, they make 400 to 1,600% on every dollar that you give the bank. And then in your savings account, they'll pay you 0.01%. And then they'll give you a 4 to 10% loan if you need money from them, depending if it's a mortgage or a car loan or a business loan or an unsecured loan. Maybe they'll charge you 15, 20% on an unsecured loan, right? So they'll take your dollar and make, and this, you can go to BauerFinancial.com and look all this up, BauerFinancial.com. Every dollar you give the bank, they take, they lend out, they make 400 to 1,600% on your money, and they charge you ridiculous sums just to lend that money back to you. So stop giving the banks your money. But we can't take advantage of fractional reserve banking, but we can take advantage of what the banks do in other senses. We can take our money, and once it's compounding uninterrupted within our money multiplier policy, we can pull that money out to accomplish number 2, keeping your money moving at all times. To create wealth, you have to have your money working for you just as hard as you work to get that money in the first place at all times. So you need to take that money, keep that money moving. And this is what we were talking about earlier with real estate investing, whether it's passive or active investing. And we'll get into that in just a second. So banks take advantage of compounding interest through being the #1 purchasers of whole life insurance in the country. So that's how they take advantage of compounding interest. So that's exactly what we do. And then the banks take all the money that you give them and they lend it out to things like car loans, mortgages, home improvement loans, business loans, debt consolidation loans, and everything else. So that's exactly what we're going to do. We're going to put our money in a policy, create the uninterrupted compounding interest, and then we're going to take that money out of the policy. Because remember, when we take it out, it doesn't actually come out. When we take it from the policy, we're taking it in the form of a loan. That allows it to stay in the policy, compounding uninterrupted and growing for the rest of your life, and simultaneously be able to take that money and use it to keep our money moving. Does that make sense to everybody? So we're mimicking what the banks do in a sense by using these policies this way. And it's very, very important. So going back to the beginning real fast, do you have good debt or do you have bad debt? If you have bad debt, let's first tackle that bad debt, because I can find 15% loans all day long where I can take my money and I can loan it out and I can get 15% annual returns coming back into my money. But if I'm paying a credit card 17% at the same time, I'm still losing 2%, right? So why would I do that? So what I need to do is get rid of the bad debt first. That should be #1 goal. Get rid of that high interest garbage debt first. And then we can look at the lower interest bad debt. So things like car loans, primary home mortgages, low interest, even low interest student loans. Like I've seen some 3 and 4% student loans. I know a lot of them are more like 7 to 9% right now, but let's look at what that is and let's run some comparisons. Because if I can take my money and invest it at 15%, and I'm only paying 3% on a car loan, you know, maybe I do this with my money and instead of using the car loan to pay that off, because I'm still netting 12% if you think about it, right? But sometimes it's nice to get rid of all of the bad debt first so we can then focus only on building wealth and good debt and leveraging and investing to grow more money, to grow more wealth, right? So sometimes we just want to get rid of that bad debt for that reason. But that's what our mapping team is really for. So those of you that are new to Money Multiplier, maybe you're thinking about starting a policy or you just started a policy, or if those of you that have been in the program, if you work with your mapping agent, you know, that's what they're going to talk to you about is, you know, what's your plan moving forward? Now that you have this policy, you know, how are we going to map out how you're going to use this policy? You know, what should we tackle first? What should we get rid of? And then what do we do with the money? All right. So once that bad debt is good, once we have the good debt, we're ready to leverage. Now we're going to take our policy, IBC policy, and we're going to move the money. So basically, what are we doing? So basically, we're leveraging our IBC policy, right? because the money's in there. We're taking that money, we're going to move that money, and we're going to use it to buy more stuff, more assets. So we're using one asset to buy more assets. It's basically all leveraging is, right? Moving money. All right. Any questions on all that stuff? All right, now let's talk about moving money here for a minute. Okay, what are ways to move money through your IBC policy? What are you guys doing? Those of you that have policies or you're already doing it, what are you guys doing now? Okay, to keep money moving and creating more money, basically you're going to do what you were doing anyways. You know, one of the great things about the infinite banking concept is we're not doing any more work. We're not spending any more time. It's not costing us any more money. It's just we're putting our money one place as opposed to another place in the policy as opposed to at the bank. And then we're using the money from the policy to do what we were doing anyways. All right. So instead of housing your money like a typical real estate deal, you're going to have a savings account. Let's say it has 50K in it. So if you do a real estate deal, let's say you have $50,000 in a savings account, you pull the money out, you do the deal, you make 100 grand, and that goes right back into a savings account, right? And then you just do it again. Now you got 100K in your savings account. You know, a month later, you find your next deal and you do the process again. It just constantly rotates it, right? But if you're doing it this way, when the money's in the savings account, what is it growing at the bank? Let's say 1%. I know it's not that much, 1%, let's just say. You take the money out to do the real estate deal. How much is that $50,000 growing out in the bank account now? Zero. Because when you take it out of the savings account, the bank's not giving you interest anymore on it. So while the deal's getting done, let's say 4 to 6 months, you're making zero. You then take the money, you put it back in the savings account, and then for the next month, while you're looking for your next deal, it's growing at 1%. Okay. So over the course of that year, let's say it took you 6 months to do the deal, a deal to find it, a month to find it, a month to find another one. You're 8 months into that year and you've made basically zero money, right? 0.012 for that month and then another 0.012 for that other month. So you made like 0.024% on your money over those 8 months. Follow me here. If we take that same 50,000, we put it into an IBC policy instead of the bank, forget the bank, we put it into the IBC policy, that money's now going to grow. Right now, around 5.2 to 6% is what the interest is what the dividends are being paid out with the various companies right now. So we'll just take the average. Your money's growing at 5.5%. Okay. Now we take that money out to do the deal, take the money out of the policy to do the same deal. What happens to that money? Does it drop down to 0%? No, it continues to compound. Remember, uninterrupted compounding interest. So when we take the 50,000 out of the policy to do the same deal, it doesn't actually come out. It's still in there compounding and growing at 5.5%. So we do the same deal, we do the same thing, we rotate it back in, we put it back into the policy, but over that same 8 months, instead of 0.024%, we've now made 8 months divided by 5.5. We now made, 4%, let's say, on the money. So we've made almost 4% more on our money for doing the exact same thing. And keep in mind, every year that you have the policy gets better and better and better. I don't have this ready to go right now. We don't really have the time, but I did an example a few weeks ago where we used a policy that somebody had for this exact process right here. They took the money and they lent it out at 12%. Remember, we're doing no extra work. We're doing no more time. It's not costing us anything more. It's just where the money goes first and where the money is housed in between doing these different types of deals. Okay, so I'll show you the premise of this example. I showed the illustration, all the exact numbers, the exact deal and everything a few weeks ago. But for simplicity here, what happened is this person had $100,000 that they lent out and made 12% on for that year. So they made they made $12,000. However, and this was money that was in a savings account that they used to invest and to do this private money deal, right? However, we showed how somebody else did the exact same thing. They found the exact same deal. They did the exact same process, the exact same amount of time, except their $100,000 came from an IBC policy that was in its 6th year. Okay, so this policy was in its 6th year. I believe it was the 6th year, 6th or 7th. It was somewhere right on. It was in its 6th year. And what they did is instead they took the $100,000 from this IBC policy instead of the savings account. And that's the exact same year, that same $100,000 they generated you can't really see it right there, but $42,000 doing the exact same deal, the exact same amount of time, but instead of taking the money from their savings account, they took the money from their private bank account, which is the money multiplier IBC policy. They made $42,000 on that exact same thing. And the reason why that happened was because in the IBC policy, in the 6th year, they put money into the policy. And because of the compounding aspect, they ended up making like 30 after the loan was paid back and everything like that, they ended up making like 30% that year, cash on cash return on tax-free growth within the policy. And when you combined the tax-free growth within the policy with the 12% they made outside of the policy, they ended up making $42,000 that year. So what would you rather do? Make $42,000 or $12,000? And keep in mind, this $12,000 is taxable. 12,000 of this is taxable, but the other 30,000 of this is not taxable. It's tax-free growth within the policy. So what would you rather have? You guys pick. So that's the advantage of running money through a policy first and doing the exact same thing you're doing anyways when it comes to investing. And I could do this exact same example with stocks. I can do the exact same answer with crypto. If you own a business, I can show you how to do this exact same process, except whatever your expenses are in your business, let's pay for the whether it's merchandise, whether it's marketing, whether it's buying real estate, whatever the case is, let's just run the money through the policy instead of a business bank account, and you'll be able to start generating these crazy returns using your business. And the best thing when it comes to using with business is a lot of times we can actually create additional tax deductions to help us on these profits. So this 12,000 in a deal, not a passive lending deal, it's not going to be, but on the active side, we might have been able to create some tax deductions from this for ourselves as well for the business. So there's lots and lots of different ways to use this for business. So you just have to ask yourselves, what are you investing in? How do you want to move your money? How do you want to start generating these extra income streams, right? So one way that I would recommend is let us help you, okay? Let us help you. And let me show you what I'm talking about. Okay, when it comes to active real estate investing and passive real estate investing, what is the one thing needed? Money, okay? Active investors need more to buy more homes. Passive investors need money to lend out to active investors to allow their money to make more money for themselves, right? So active and passive investors, no matter what, they all need money to be able to accomplish what they want to accomplish, all right? So how do we introduce, if you're a passive investor, how do you meet active investors? And if you're an active investor, how do you meet passive investors, right? So here's your options: network, This I'm a huge fan of. Networking is probably created more relationships and success for me over the last 14 years, being in real estate and entrepreneurship and owning businesses, than probably anything else that I've ever done. So there's lots of different ways to network. You can join what are called RIAs, Real Estate Investment Association groups. There's a lot of meetup groups nowadays. But almost every major and even rural area nowadays has some kind of group that meets up on a regular basis. Now, COVID threw kind of a wrench in that whole thing, which a lot of people went virtual, or they're starting to go back to them. I know here in Florida, we've been back to them for a year now, but I know different parts of the country are different. So that can be tough though. Right now in the world that we live in, networking can be harder to do. All right. But I guarantee you, if you look around, there's somebody somewhere in your area that has some kind of meetup or RIA group that you can join, and you can attend the meetings on a regular basis. And you can, that way you can meet active investors that are looking for money. If you're an active investor and you need money, you're going to meet people with money that are looking to lend it. So you can talk about it. You guys can meet in person and network. Masterminds. So for example, we have the Money Multiplier Experience Mastermind coming up in Sundance, Utah in March. All right. I actually just booked all my travel for it. So we're going to be out there for a few days, and, masterminds, groups like that are where you can really meet other like-minded people and people that are looking to accomplish similar goals than you. I guarantee you, at the Money Multiplier Experience Mastermind, you will meet passive and active investors both. And I'll give you a little hint, some very big players as well. So if you're really looking to really take your business to the next level, you're investing to the next level, your finances and income streams to the next level, that mastermind, I would be there if I was you. I don't know if we have any seats left for it or not, but just ask Shauna, and Shauna can let you know and give you all the details. All right. So that's a great place though to be able to accomplish this. Networking, either online. There's a lot of online groups nowadays. I'm just a little weary of things on Facebook, groups on Facebook, things like that. Unless you know the people, or you have a personal introduction, something like that, and you trust them, there's just a lot of like scammy stuff out there right now. So just be careful with that. But all right. So that's one way to do it. Something that Chris and I talked about at a bar back in 2019, and we've started to put together, and in 2021, it started to really grow and blossom, is what's called the Private Money Club. So the Private Money Club was created for that exact reason right there, to allow active investors and passive investors to meet each other in a network where everybody in there is trained. They've been through our trainings. They're educated on what to do. And basically there's rules that every single person in there must follow to do deals. So if you're an active investor and you need money for a deal, you're going to know that you need to put together a perfect loan proposal. You know that you're going to need to explain, is it a first lien position, exactly all the terms, what the details are. You're going to have the correct insurance in place. You're going to use the correct mortgage or deed of trust. You're going to have the contract or the promissory note done properly. And you're going to have, everything done right. And if you're a passive investor, you know what to expect. You're going to look at that perfect loan proposal. You know that you're going to have us on there interviewing some of the borrowers and talking about the deals, the pros and cons. You know that you're going to have a support team in place to run questions off of. You're going to be able to get on our monthly coachings on MSTV through the Private Money Club, and you're going to be able to ask questions, and you're going to get the support from Chris, myself, different experts we bring in, our mentors, and our entire team to make sure that everything's being done the right way. Because let me tell you something, nobody cares more about your finances and your money than you do. So it needs to be done the right way. So that's why the Private Money Club was created. And that's what the Private Money Club does. It introduces active and passive investors together, where you can build that initial relationship and you can blossom it over time. And it's a beautiful thing. So if you are looking for help with all of this and you don't want to go out there and do it all on your own, then check out the Private Money Club. You can hop on and watch some of the videos for free and start checking out how some of it works. And if you want to join, we'd love to have you. It's a $997 a year membership that includes, everything that we've been talking about, the education, the support, other opportunities. Like I said, we're going to have Kevin come in next week that talks about notes, which note investing, if you're a passive investor, notes are awesome way to invest and start growing your passive income that way. So I'll bring Kevin on next week, but he's in there and he's posting what are called wholesale notes. So he goes out and he finds them, he puts them in there, he makes a few $100 or something, but you can buy them directly from there, or you can go to Kevin and he'll teach you how to go out and buy notes on your own. Again, we always want to provide, whatever, everybody's different. Some people have the time and the wherewithal to go learn something new and go out there and implement it and do it. Some people just want to pay a little bit extra money up front to have somebody do all the work for them, but still get all the benefits at the back end. So whatever works for you, do. If you have the time to be an active investor, get out there and wholesale and flip some deals. If you don't, put your money into the deals and make great returns on it. It's plain and simple, right? It's pretty simple. So what I'll do, we're right at the hour mark right now. I wanted to pull up the Private Money Club and actually start walking you through it, because there is a lot in there, whether you're an active investor looking for money, whether you're an active investor looking for rental properties, looking for notes, whatever the case might be. We have all that in the Private Money Club right now. Or if you're a passive investor and you're starting to want to analyze some of the deals that are in there, what are the pros and cons? What should I be looking at? I want to be able to walk you through these deals. So that's what we'll concentrate on next week. I'll bring on Dwight. I'll have him introduce you to the new deal that he's putting on the Private Money Club right now. We'll walk through it on the Private Money Club, and then we'll just go through the whole thing. So if you're an active investor or passive investor, next week, we'll walk through the whole Private Money Club. So if you're already a member, I can show you some tips and tricks on how to use it better. If you're thinking about joining this year in 2022 on the active or passive side, I'll walk you through it to show you everything that's in there and what you're going to start doing to take advantage of it. Okay. That'll be a good talk for next week. That's actually perfect. So we're right at an hour in right now, guys. So I want to keep these to right at that hour mark for you. Respect your time. So does anybody have any questions? Hopefully this was beneficial today to you, but that's what 2022 is going to be all about, is generating wealth, keeping your money moving at all times, and starting to prepare yourself for the opportunities when these markets do start to pull back and possibly crash coming this year, next year, but be prepared for it. But in the meantime, don't lose out on gains. Keep your money moving, keep your money growing. We have inflation still skyrocketing right now. So you can't just have money sitting. You got to keep that money moving to deal with inflation and things like that. But there's safe ways to do that, eliminating the risk. And in my opinion, one of the best ways to do that is through passive lending right now. You're way outpacing inflation. It's in a vehicle and it's backed by assets that are very strong right now. So in my opinion, that's a great way to keep that money moving. And the returns are good, 8, 10, 12, 15% returns. So you're outpacing inflation in that manner, but you're not tied into long-term investments. A lot of these private lending deals in the Private Money Club, 3 to 6 months, you're getting your money back, turning it over, going to the next one. But that way you have control of your money in the short term. So if things do start to turn, you can redo your strategy. But no matter what your plan is this year, please have a plan, have a strategy. If you need help with any of this stuff, guys, join MSTV. $19 a month. Hop on our group coaching calls. Those of you that are members in the Private Money Club, schedule a call with me. Let's talk about what your strategy is. Let's start implementing this stuff and getting that money going for you. But I hope you guys are off to an awesome 2022. John, absolutely. John said money attracts money. You're absolutely right. So get the positive thoughts out there, get the positive vibes going. I'm looking forward to 2022, working with every single one of you. Thanks for being here. You guys have an awesome week. We'll see you next week. Thanks.